Welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and that's
Brian Leverage.
good job. You know your own name. I love it. And we're not even drinking today. That's probably why you remembered who you were. We're not drinking today because we're filming this on the interwebs. I don't know if you guys can tell that or not. We're not in the same room. At least I don't think we are. It would be kind of weird. Anyway, so we have a very exciting guest today, Brian. Who do we have on today?
I think we have your longtime friend and business partner and ours jointly, Travis Bronik.
That's right. We have Travis.
He's going to talk to us about real estate, not the Southeast. I mean, what are
yeah, I mean, we're definitely going to talk about real estate. So I've known Travis, as you alluded to, for, I think close to 20 years now. We met when I was in law school. And we were both in some of the same classes together, some of the same groups together. Travis and I have been partnered since 2010, 2011 on multiple real estate investments, including multifamily. He's doing all kinds of exciting stuff in Detroit. He is in multiple markets all across the country. I'm going to let him tell us all about what he's doing. It's very exciting, and we're going to do it right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
All right, Travis, welcome to the show.
Hey guys,
Hey.
thanks for having me on.
We're happy to finally have you. It's very difficult to. This is episode Travis Bronik.
I know, but what number?
It's around 50. It's like 47, 48, 49, somewhere
so
around
nice
there.
of you to think of me after 49 episodes. I really appreciate it, guys.
I love it to get you on a lot sooner.
It's true.
I'm just kidding.
I've been very resistant to having Travis on because he makes me look bad because of how awesome he is.
Oh, wow.
So Travis, we've known each other for a few minutes and we have real estate together, and even Brian and you have real estate together now. We partnered this year to buy an apartment complex here in Chattanooga. So why don't we start and we talk a little bit about how you got started into real estate, like just the short version and kind of what you're doing right now.
Wow. Short version of how I got started in real estate. So there was a lull of time in between undergrad and law school. Graduated early, and I became a mortgage broker, and I was really, really bad at it. But what I realized by virtue of being a mortgage broker was there was a ton of money in real estate. I worked with investors. I saw guys buying and selling. And I said, wow, I want to be part of that. Of course, I was young and I didn't have any money. So what did I do? I leveraged a credit card, right? I took a 0% credit card, bought my first house on that credit card, put sweat equity into it, and flipped it. Early on in my career, I flipped properties. I probably have flipped close to 500 homes inside of Detroit. I created turnkey properties and specializing in subsidized or Section 8 housing here in Detroit. That's in a nutshell how I got started off a credit card.
So, all right. So you must have had that really big line of credit to put a house on a credit card.
Oh, wow. Maybe 20,000. I don't know what they gave a punk kid back then, but they sure didn't know that I was using it for a house. I don't think, right? They give you those checks and, say, go write a check, right?
So you wrote like a 0% interest credit card check to buy a house. That's fantastic.
Yeah.
Of course, houses were a little bit cheaper in your market than what most of our viewers might be familiar with.
Oh, wow.
I'm just guessing, right? So what do you remember about how much that first property cost?
12 grand, maybe. I don't know. And they say everybody knows their first house, right? But they're all kind of a blur at this point. But, somewhere in that range, maybe it was 12,000 and maybe I put 3,000 or 4,000 in it. Maybe I sold it for somewhere in the mid 20s. So that seems to be, if I'm thinking back to when I was selling quite a bit, we were selling them, probably the 30K mark, 28 to about $34,000, which was great because in the last downturn, I was buying houses where we got down to $500 or $1,000. So, still tons of profit after doing the renovations.
Yeah. So, and you did a lot of those, and now you're not doing a lot of that now, right? Like your strategy now has evolved. I know this because we partnered together and we have more than 100 units of apartments together, and I know you have a bunch more on top of that. So why don't we talk about like what's your focus now and what are you doing with that?
Gosh. Yeah, I mean, multifamily housing is definitely, my focus, right? Is finding, looking for properties that really are add value, and looking for things, add value for me is something that has been mismanaged, something that I can come in, put my twist on, and preferably raise the rents and lower the expenses, which, might be a little challenging in some markets right now. But, surprisingly, during COVID, we've had awesome success. When we've targeted, as we've targeted some distressed buildings here in the Detroit market where we knew with sweat equity and focus, right, we'd be able to really create that value.
Let's talk about that for a second. Now, this is not a deal that neither of the two that you've done recently are deals that I've been personally involved with, but you bought a 32 unit building and a 22 unit building, I think, since COVID. Is that right?
Yeah. Yep.
And those were pretty cheap, right? So like the last 32 unit building that I bought, I bought with you was, millions of dollars, not millions, but more than $1 million, less than 10, right? It was a big chunk of cash. Mm-hmm. And the 32 unit you bought, what did you pay for that?
$190,000.
So you went
That's
to the
a little
bank.
disruptive though, guys.
Did it come with land?
No. Yeah, right. Yeah.
So you went to the bank with 20% down on that deal? So you put $40,000 down on the deal?
No, that deal was a little bit different. No, that is a true add value deal, right? It was a little bit more than a shell. The roof's great. The structure's real sound, right? But it's 32 kitchens that have to be put back in, new plumbing, little new electrical, new HVACs going back in. So it's interesting, right? But when I started this year, I really had on my goal sheet, I said, I want to go back to my roots, right? My roots were taking dilapidated properties in Detroit, renovating them, and creating huge value. And I said, I've been in the multifamily space now for a few years, so let's go find a building and let's do the same thing. So, before the 32 was the 22 that I bought right before that. And that's the problem, in real estate, right, is the deals sometimes fall into our lap when we're least looking for them. We say, there's no deals. And then all of a sudden it's like, oh, there's too many deals, but it's too good of a deal to say no to. So, I went from no deals to having, 54 units right on top of each other, both complexes needing, extensive work.
How did you decide to make that jump to go from single family, which you've done predominantly throughout your investing career, into multifamily?
For my sanity's sake, right? I mean, it's hard. It's super hard to scale single family properties, right?
A little bit, yeah.
Yeah, just a little bit. When we're talking of multiples of hundreds, it gets pretty difficult in scaling that operation with maintenance and leasing and everything that's part of the business. But with multifamily, we get a ton of synergies, right? And we really can drive the value of the property. I mean, once I started to understand forced appreciation, that concept, it's a no-brainer.
Yeah.
I mean, you can't do that with a single family asset. The value of that asset, right, is directly derived by the market of single family home sales, right? For a traditional, typically for a traditional, buyer, right? A homeowner, if you will. Investor might be looking at the return, but, really it's based off what other properties in that market are selling for, not on an investment basis. So
let me ask about that forced appreciation for people that maybe don't know what that concept is. So when you're talking about that, you're talking about the inverse relationship between a cap rate and the net operating income. So how does that work? And like, how do you actually force appreciation?
You can do a couple things, but the two basic things are we can drive rent up and we can lower expenses. And if we know what the cap rate is in a market, right, our NOI rises, right, we're going to raise the value of the asset. So typically when I'm taking over a project, as you know, right, we already count on that we're going to have some turnover. And I use a pretty high number that would scare a lot of people. My number is 40%. When I'm looking at a property that's been mismanaged, that I believe that's been mismanaged, I already assume that I'm going to lose 40% of the tenant base. And for me, I want to do it quickly. I don't want it to sit and fester, and that scares a lot of people, right? Because we have debt service, usually big numbers on these buildings. But I want to get in and I want to create that value.
Yeah. So what I think what you're saying is that if you can raise the rents and or cut back on expenses and therefore increase the net operating income, the value of the building just purely goes up on its own. That's the nature of how multifamily works, because you're really valuing a stream of future cash flows. And we did do a whole episode on this a year or so ago. When we should have brought you on then, maybe, but it was the Cap Rates Explained episode, which, Brian, it's going to be right above your head. So point up there, right there. That's where it is. So you just click that link and you can get to that episode.
Yeah, I mean, we we just finished a deal here, right, that we bought 15 months or so ago, right? And we worked on it super hard. We raised the rents up, right? We decreased the expenses, and we increased the value by, the some odd percent, right, in the building.
Yeah. So let's talk about that for a second. So you and I have bought 4 apartment complexes together now, I think, if I'm counting right. 4. Yeah. Well, we have the one in Chattanooga, 3 in Michigan. Yeah. So, and Brian's involved in the one here, but now on 2 out of the 3 that we bought first, right? The one we bought this year, we haven't done it on, obviously. 2 out of the 3 we bought first, we've successfully gone through a refinance in one case, less than 2 years of ownership, and the other one about 2 years of ownership, where we were able to pull out more than our original down payment and they still cash flow. And that's where the value add comes in, right? That's really where the magic happens.
Oh yeah. Then you're in infinite returns, right? I mean, that's the magic. All my skin is out of the game.
Yeah. And the only reason we have it on our 32 unit is because we didn't know what we were doing when we got the financing on it, and we're stuck with a huge prepayment penalty as a result of that.
Bank, right? That's the piggy bank right there. So
yeah, that's right. That's right. I mean, there's a ton of equity sitting there and it just sits there.
Do you cap your LTVs when you're looking at refis on stuff? Like, a lot of people say 80% maybe or more conservative, or in that
whatever the bank's going to give me right now, right? It's got a cash flow. I mean, I'm buying buildings, I'm managing buildings based on cash flow. At the end of the day, it's great to talk about value creation, but until we're actually selling the asset, does it matter? I mean, it matters just so we can refi, right? So I want that huge number so I can refi, but obviously, and I want to get as big of a number as possible so I can take out as much cash as possible to go redeploy, right, and buy additional assets. But I think 80%, 90, whatever they're going to give me, I think 80% is pretty typical, or probably 75% is what you would see, right? I think if you're on a fully recourse product.
Yeah, and that's what we're seeing too. So we're only scratching the surface of the stuff that you do. Let's talk about your property management company for a minute. Are you currently taking on new owners, building owners that want managers?
We're super selective though. You have to be aligned with my vision, right? And the way that we manage people. We really strive to put our owners and our residents at the forefront, right? We live by one rule, and that's the golden rule: treat other people how you want to be treated. I only believe in doing things the right way. So very selective. We hear all the time about being selective and choosing a property manager. I'm super selective in the clients that I allow to come on and join our family, right? Because truly it is that. We work relentlessly for our clients to ensure that they're getting all of the rent that they're entitled. And the same for our tenants, ensuring that they're getting the service that they're entitled to. Yeah, we've been, during COVID, I know there was a lot of property managers that held back on rent increases. And for me, it was quite the opposite. This rental market's up. So if there was an opportunity, I've been raising rents where it was warranted.
Right. And the markets that you work in are mainly the Metro Detroit market, right? Detroit and the surrounding areas.
Yeah, exactly. Surrounding suburbs of Detroit, probably within an hour.
Okay, great.
Our corporate offices are in Southfield, Michigan. Yep.
which I recognize that you're in your corporate office right now because I have been there a few times, it turns out, in my life. And all right, so you're selective about who you bring in. How else can people get involved with what you're doing? What are you looking for? Like, what kind of people do you want to meet? Things like that.
Yeah, I want to meet anybody that's interested in real estate and wants to change their life. It's truly impacted my life, my family's life. It's allowed me to leave the, I'm a recovering attorney like you, Jeff, you know that. So
I'm a little bit further along than you. You keep taking cases. You got to stop. You're like the alcoholic that once in a while goes for a drink. That's where you're at. You're the half recovered attorney.
Yeah. But truly anybody that's interested in learning more about real estate, or maybe somebody that's in real estate, that's in smaller deals and single family, but just can't shift their mindset in getting into the bigger commercial deal or the multifamily, love to talk with you. I think that I could share a lot of perspective. Yeah, there's my website down there, primerentalproperty.com. You could reach me by email at Travis, Travis, at c2cdetroit.com. Happy to connect again with anybody who's interested in, just talking real estate, wherever it might be.
And that C2C, that's C and then the number 2 and then
c2cdetroit.com.
Yeah. All right, very good. So Travis at C2C, and that's Coast to Coast Group, right? That's what the C2C
that's the
is.
Coast to Coast Group. Yeah. So we're in. We have a pretty diverse portfolio. So we can talk intelligently about different asset classes, whether it's hotels or commercial buildings or small.
Right, and you invest in multiple.
Lost you guys.
Brian. Well, I can still hear you. Hopefully.
I can hear you now.
All right, great. So you invest in multiple markets as well.
Yeah.
I know that you invest here in Chattanooga with Brian and I, and of course in the Metro Detroit area. But you also, I believe, have property in Kentucky, New Mexico. Are there any other markets that you're in?
Man, I don't know. I'm losing track, but yeah, I think that's it for right now.
Fair enough.
Yeah.
All right. Well, listen, Travis, it's always good to talk to you.
You too, guys.
We talk to you about, at least I do, about 3 to 5 times a day.
True.
So it's not exactly a surprise for me to be able to talk to you. But listen, I would encourage all of our listeners to reach out to Travis either by email or at primerentalproperty.com. There may be opportunities to invest with him or invest with Brian and I on deals. So you should be reaching out to us at oldfashionedrealestate.com as well, or on Facebook or Instagram or any of the other places where you follow Old Fashioned or Travis or Jeff or Brian. Brian, if they follow you on Instagram, are they likely to get a hold of you?
Probably not.
That's kind of what I thought. Brian is the least Instagrammy guy I know, although I tag him all the time in Old Fashioned posts. And Travis, anything you want to share with the audience before we leave?
No, just thanks a lot for having me on, guys. I really appreciate it. It's nice to talk about real estate. It's always fun to talk about real estate. And I wish everybody success that may be listening.
All right. Well, we're definitely going to have you on again
Great, guys.
because it's always a good time. And I hope to get you down here to Chattanooga soon.
Yeah, me too.
Yeah. So, by the way, how long have I lived in Chattanooga?
I don't know, 8 years?
10 years now, actually.
Oh, wow. Well, I'm going to come for your decade anniversary.
That will be January 7th. So January 7th is the 10-year anniversary.
Okay, I'll make it down then this year for sure.
All right, we'll see. We'll look forward to seeing you here in Chattanooga. And this is the end of the Old Fashioned Real Estate Show. I hope you guys enjoyed. If there's anything you need, just reach out. Have a great day.
Have a good one.